Office markets across Canada experienced a dramatic twist of fate in 2020. Many office markets started the year with exceptionally strong fundamentals, leaving limited options for tenants. As the pandemic hit and tenants left offices to work from home, a fog of uncertainty about the future of how we use office space has clouded the office outlook. We now need to somehow quantify how work from home will impact office vacancy rates in the short term, and how this shift in workplace strategy will impact the office market in the long term. We are also trying to determine what will happen to all these lease expiries that are set to occur in 2021, along with the many one-year renewals that occurred in 2020 as tenants kick their space usage cans down the road. Furthermore, even after a vaccine is available, how is all of this impacting rents and values? And is this happening uniformly across old and new buildings in both downtown and suburban markets? Welcome to the Colliers perspective on the Canadian office market. My name is Roelof van Dijk, Colliers' Senior Director of National Research and Analytics for Canada, and I hope to share with you our insights on how the Canadian office market is performing, but more importantly, shed some light on the anecdotal trends as well as provide an outlook for 2021 and beyond. Before we can discuss the office outlook, we need to first look at the economic outlook, specifically the expected rebound in employment, since office buildings are essentially just a fancy place to put your people. Well, at the depths of the pandemic lockdown in April, Canada saw over 3 million jobs vanish. The good news is that approximately 80% of these jobs have essentially been recreated as of November 2020, and the Conference Board of Canada is forecasting that the remaining 20% will be recreated or new jobs created, bringing us back to a net positive job growth scenario by year-end 2021 or early 2022. However, as many jurisdictions across the country continue to struggle with a resurgence of COVID-19, expect this relatively rosy job outlook to slow and the return of the remaining lost jobs to take a little longer than anticipated. More relevant to the office sector is employment in the finance, insurance, and real estate sector, as well as professional, scientific, and technical services sector, as these sectors are intensive users of office space. Employment in these sectors is actually up 1.2% and 2.5% respectively in 2020 year to date as of November, essentially regaining all the lost jobs and more. So where are all these people physically working, and how have office markets across Canada performed in light of the pandemic? Unfortunately, the equation between job creation and increased office usage is now effectively broken, because despite jobs being created, office vacancy rates are on the way up, and net asking rents are on the way down. Overall office vacancy across the country is up 160 basis points year over year and now sits at just under 12% at the end of Q3 2020. This increase is being led by the downtown markets, which are up 190 basis points over the same period, reaching 11%. And although suburban vacancy is higher, the increase is occurring at a slower pace, less than half of what we've seen in the downtown markets. A big part of this increase downtown is related to the massive amount of sublet space coming back on the market. In fact, the downtown Vancouver office market has seen sublet space increase by almost 550% year over year, with downtown Toronto sublet space up over 350% over the same period. The magnitude of these increases is apparent when compared to the increases seen in the suburban markets, which equate to about 25% year over year in each market. One of the main reasons we're seeing this increase in the downtown markets is because the space is not being utilized as much as in suburban or less dense markets. In fact, the physical occupancy, and by that I mean actual people showing up to the office, is averaging only 10 to 15% in dense downtown markets. Whereas more suburban and car-centric markets, where employees don't need to take public transit to the office, is seeing physical occupancy rates as high as 30 or even 50%, depending on the market and the tenant. This leads credence to the hub and spoke office strategy many are discussing. The question is whether this is a temporary trend that will be here until a vaccine is distributed, or if it is a more permanent trend as younger workers move out to the suburbs for more space and decide to stay there. Some argue that rising vacancy is not impacting landlords just yet because it is mainly a sublet problem, and that is increasing the overall vacancy rate. And although this is true to an extent, landlords are not an island unto themselves. Initially, most sublet offerings did appear to be smaller spaces in and around 5,000 square feet, many with shorter terms. However, more recently we have seen larger spaces, 20,000 square feet and above, come to the market, some still having significant term left. Granted, some of these sublet offerings are tenant posturing, using it as a bargaining chip for lease buyouts or renegotiations, but some of this space is now competing directly with landlord offerings, not to mention that many sublet offerings will likely revert back to the landlord at the end of the term. Furthermore, due to the new supply coming online and in the pipeline, the expectation even prior to COVID-19 was that vacancy was on the rise, and many landlords are keenly aware that they will need to compete with sublet space if they want to stick deals. Despite this, average rents seem relatively flat across the country. In fact, overall average net rents are up 4% year over year, with downtown rents up 2%. How can this be? Well, these increases are partly to do with the product mix on the market. As higher quality space returns to the mix with higher asking rents, the average moves up. What we can tell you is that same space rents have not moved up at all, and that the real movement in rents is occurring on the net effective side. Keeping face rents elevated keeps building and portfolio values higher, which is also helpful for remortgaging purposes. However, significant tenant inducements and free rent periods are now part of every lease negotiation, compared to the take it or leave it discussions at the start of 2020. And as vacancy rates continue to increase, these inducements are not going away anytime soon. So what is the outlook for vacancy rates in 2021? For the most part, vacancy in key downtown markets, not including Calgary and Edmonton, could potentially increase by 50% between now and early 2022. And this does not include shadow vacancy. This is partly due to additional sublet space coming back to the market, but also due to significant new supply and the resulting backfill situation in the older buildings. In fact, further to the trend we were expecting to occur prior to the pandemic, the increased vacancy is likely to impact older buildings more, partly because of the pre-leasing commitments in the new supply and the vacancy that was already expected to occur in the older buildings as tenants make their moves to the new builds. But now, this will impact them because of the relative difference in wellness and efficiency between the newer and the older buildings. Tenants and their employees are quickly becoming keenly aware of air quality conditions in their buildings, and as well as elevator efficiency, these building attributes will go a long way to either attract or deter tenants in the coming years. Landlords will likely take one of four approaches. The first being to invest in upgrading their buildings. The second being to leave the building as is and deal with the resulting perceived downgrade in quality, increased vacancy, and reduced rent appreciation. The third being redevelop. And the fourth, repurpose their building where possible to a different use, such as multifamily. But this only works if the building design lends itself to this type of repurposing. What we do know about the return to work strategy right now is that nobody is really comfortable making a big decision about office space given all the uncertainty surrounding COVID, the vaccine, and the future of work from home. Furthermore, most companies are not interested in taking on significantly more space in order to space out their employees or completely redesigning their office layouts and buy new furniture to accommodate physical distancing, simply because these things cost a lot of money. And right now, companies are looking at ways to reduce spending. As such, we expect companies to continue to stagger their employees back using a phased approach, allowing employees to space out using time while continuing to employ work from home strategies to accommodate this. Fast forward a bit, and it is clear that companies will only continue allowing work from home to their employees as long as it helps them attract talent and does not prove detrimental to productivity. However, even if work from home remains an option, most employees will likely not continue to do so on a permanent and full-time basis, as people generally have a fundamental desire to be around others to socialize, collaborate, and build rapport. Furthermore, there is always that ingrained desire for face time, particularly with the boss, to ensure mentoring is occurring and that they are top of mind when it comes to promotions. In regards to the square foot per person metric, there is a clear need to reverse the long-term trend of densification and reduce square footage per person that we have seen over the last 3 or 4 decades. Besides, we are already reaching the limits of productivity improvements from this open, collaborative office anyway, even prior to the pandemic. Companies will now need to allocate more space for people who are in the office, but at the same time, they will likely leave the square footage per employee headcount in place at current levels and instead achieve the higher square footage per person number by allowing more work from home. As such, we do anticipate the need for office space to remain a fundamental part of businesses' workplace strategies for the long haul. Again, my name is Roelof van Dijk, Colliers Senior Director of Research and Analytics for Canada, and thank you for watching the Colliers perspective on the Canadian office market. For additional information or reports on specific markets that interest you, please visit our website at www.collierscanada.com. Thank you.